We often want to know what's the return to equity when there is debt in the capital structure. Please take a moment to pause the video and read the problem. You're going to buy a coffee shop that's valued at $75,000, and you're going to borrow $25,000 in order to do it. Let's look at what this is going to mean in terms of the return that you're going to get now that you're going to borrow money. First, you might want to know, where's that $75,000 coming from? Why is it valued at $75,000? Well, first, let's look at the return that you can expect to get. There's a 1/3 chance of it being weak demand or bad economic times, and you'll get a $75,000 return a year from now. There's a 1/3 chance of it being average times, expected times, and you'll get a return of $84,000 a year from now. And 1/3 chance of strong demand, in which case you'll get $93,000 a year from now. If you add all of these up, you have $84,000 a year from now. Well, what's that worth today? The first thing the problem said is that you're going to have a risk-free rate, or the risk-free rate is 4%, and you're going to have a risk premium above the risk-free rate to account for the risk of the coffee shop of 8%. So therefore the appropriate discount rate for the coffee shop is 12%. Well, if you're getting $84,000 1 year from now, and I want to discount that back one period by 12%, that's $75,000 today at year 0. So what's the return that you're getting? Well, first you have to look at what you have to give up to the debt holders. You are borrowing $25,000 at a 4% rate of interest, so you're going to owe $26,000 in 1 year. Well, you expect to get $84,000, and you're going to have to pay $26,000 to the bondholders to pay them back. They get paid first out of those earnings. That leaves you with $58,000. Now, let's look at what return you're going to be getting on that $58,000. So, you have gotten $58,000. You had to pay $50,000 to get that return. That gives you a return of 0.16 or 16%. Now remember, there were several other outcomes. You could have had weak demand. If there was weak demand, then you'd only get $75,000 in 1 year. You still have to pay back the bondholders, so you get $75,000. You pay back $26,000 to the bondholders. That leaves you with $49,000. Well, what's your return? $49,000 minus the $50,000 that you have to pay, divided by $50,000, you've got a negative $1,000 return. That, in dollars, that accounts to a 2% return when put into percentage terms. Now, you also could have had strong demand, in which case your return would have been $93,000 in 1 year. You still owe $26,000 to the debt holders. That gives you $67,000, and my 7 just disappeared there. $67,000. So my return is going to be $67,000 minus the $50,000 that I paid divided by $50,000, I have a fantastic 34% return. What this says is that leverage is good in good times. I earn more. I'm getting 34% instead of 16% in good times, but leverage is negative in bad times. I'm getting a minus 2% if it is weak demand. So having leverage increases returns in economic good times and decreases returns in economic bad times.